Hi viewers, I am Dr. Velavan, Faculty, School of Management, Sastra, deemed University. To the continuation of the previous session, now we are going to discuss about the insurance and hedging. So, what is hedging? Hedging is a process where risk is transferred to a speculator through ways like purchasing a future contract. Though insurance is not hedging, one similarly that can be drawn between the two is that an insurance contract is used to transfer the risk without creating any new risks. Okay, so hedging is a process where risk is transferred to a speculator through ways like purchasing a futures contract, though insurance is not a hedging. So here it's a purchasing of future contract, and it is not insurance is not a hedging. So one similarly that can be drawn between the two is that an insurance contract is used to transfer the risk without creating a new risk. Okay, here we are going to discuss some distinction between hedging and insurance. Okay, so there are two major difference between hedging and insurance here, and you see the risk that can be transferred in insurance is insurable risk. Okay, in case of insurance, the risk that can be transferred in insurance is an insurable risk. In the case of hedging, the risks are uninsurable. So, regarding risk in insurance business, it is insurable. In hedging, it is uninsurable. Okay. The second one is by applying of the law of large numbers, the insurer can reduce the risk. Okay. By applying of the law of large numbers, the insurer can reduce the risk. Wherever in hedging, risk can be only be transferred and not reduced. Okay, in hedging, wherever the risk can be only be transferred and not reducing. So this is very important. Here you see the following tables shows that the basic difference between gambling, speculation, hedging and insurance. Okay. So being a student, when you study the different types of insurance or like fire insurance, general insurance, marine insurance, life insurance, and cargo and machinery and burglary, whatever it may be, theft, etc. Here you have to know the difference between gambling, wager, speculation, hedging and insurance. Okay, you see one by one. So first gambling, then second one is speculation, third one is hedging, then fourth one is insurance. Okay. Regarding risk under gambling business, it is a speculative risk. Okay. The risk is called speculative risk, both gambling as well as speculation. And insurance, it is called a pure risk, because insurance business, particularly general insurance business, is only because of based on the pure risk. Either it may be a fire or marine or accident or theft or burglary or losses due to natural calamities, whatever it may be. Okay, so the risk should be a pure. Regarding profit, in both gambling and speculation will be treated as a profit or loss. And insurance, this is a loss or no loss. Okay, the insurance, here there is no chance for making a profit at the time of receiving compensation from the insurance company. Okay, then third one is socially unprotective for the gambling and the speculation. So particularly gambling is socially unprotective, and regarding speculation, society may benefit even if loss occurs. Society may benefit. Regarding benefit, speculation. Here you have invest your money in a share market. So when the share price is increased, ultimately you need, you have a chance to earn more profit. When the share market price is reduced, here you have a chance to lose your money. So both are, explicit loss. Both are explicit loss as well as profit. So everybody can know. Anybody can know. Everybody knows this result will be happen in speculation business, either profit or loss. But in insurance, it is socially protective. It is socially protective because you. I'll give an example. You take an umbrella. Umbrella is one of the tool to protect the entire family at the time of rainy season. At the time of rainy season. So here insurance is also one type of umbrella. So when the person or company takes insurance, definitely at the time of loss, the insurance company will take care of the entire company as well as the family based on the sum assured. Based on the sum assured. Okay. The next one is one party gain, one party lose. Definitely in gambling, there will be a two party. The one person will be the beneficiary, another person will be the loser. Okay. In speculation, there is no two party, it is individual game. And insurance, both parties win if loss does not occur. In insurance, both parties win, loss does not occur. But take for example, Mr. X takes insurance policy, one insurance policy regarding the life insurance. So there is no tragedy in his life, no problem at all. He will receive the maturity value at the time of maturity. At the time of maturity. Here also the company will not be suffered. The company is also not suffered here because the company need not pay any compensation in between the policy date to the maturity date. So when the tragedy will happen, at that time only the company will give some response, compensation. So here both parties win if does not, loss does not occur. Okay. The new risk is created in gambling. New risk is created in hedging, but there is no new risk in speculation, only existing risk. But in regarding hedging, transfer of non-insurable risk. So here the non-insurable risk is transferred to one person to another person. But in insurance, transfer of existing risk only. Okay. Insurance, transfer of existing risk only. Okay. Then the risk, only risk transfer, no reduction. In hedging, only risk transfer, no reduction. But in insurance, risk transfer and risk reduction both will be happen. In under hedging, not based on law of large number, but in insurance can reduce the objective risk of an insurer by application of law of large number. Okay. The next topic we are going to discuss is types and the classification of insurance. This is very important. What are the various types and classifications of insurance? Okay. Insurance is classified under the following categories. Insurance is classified under the following categories. One is government administered or social versus private insurance. Simply it is called government as well as private insurance. Then individual versus group insurance. Then life versus general insurance. Life versus health insurance. Life versus annuities. So these are the 5 types of insurance. Now we will discuss one by one in detail. Okay. Now we will discuss about government versus private insurance. Government insurance program are the insurance programs which are carried out by the government. Okay. So this type of insurance are carried by the government. Okay. They can be classified further into social insurance. Example, universal health insurance scheme for BPL families, rural insurance, etc. Oh, okay. So they can be classified further into social insurance and other government administered social security schemes. Other government administered social security schemes. So these schemes emphasize on social equity through income redistribution. Example, Employee State Insurance Act 1948. It's also called ESI Act. Then Employees Provident Fund and Miscellaneous Provisions Act 1952, EPF and MP Act, etc. Okay. Social insurance comprises social benefits provided to participants in insurance schemes that meet at least one of the following conditions. Okay. So they meet at least one of the following conditions. The participant in the scheme is obligatory either by the law or under the terms and conditions of employment of an employee or group of employees. Okay, the participation in the scheme is obligatory either by law or under the terms and conditions of employment of an employee or group of employees. Okay. Second one is the scheme is a collective one operated for the benefit of a designated group of workers, whether employed or non-employed, participation being restricted to members of the group. Third one is an employer makes a contribution. An employer makes a contribution to the scheme on behalf of an employee, whether or not the employee also makes a contribution. Okay. In contrast, social assistance premium or payment in some social insurance schemes are contributed directly into the scheme on benefit of participants. Okay, the contribution is known as the social contributions. They may be made by the participant themselves or they may be made by the employers on their behalf. Okay, if the social contributions are made by the employers, they are considered income in kind. Okay, there are a number of ways in which employees can make social insurance contributions depending on the legal and the situational structures of the country in which the employer is operating. Okay, number one, payment may be made to government, general government. Payment may be made to general government. Number two, payment may be made to a designated external fund administered by government or to an insurance company or similar financial institution. Okay, number one is payment may be made to general government. Number two is payment may be made to a designated external fund administered by government or to an insurance company or similar financial institutions. Third one is money may be set aside in a designated fund that the employer operates to finance its social insurance obligations. Okay. Fourth one is the employer may meet its social insurance obligations out of general corporate funds. Okay, the employer may meet its social insurance obligation out of general corporate funds. Okay, in this case, the value of the social contribution is assumed to be equal to the amount that the employer would have to pay an insurance corporation to provide cover to meet the obligation concerned. Okay, such imputations are unlikely to be made for individual employees, and the employees are not able to report their value in household surveys. Okay, a participant in a social insurance scheme may be covered by the different schemes for different types of benefits, and those schemes may not be operate in the same way. For example, an employer may be contribution to the general government to provide for the employee's future retirement pension and to an insurance company to cover the employee's medical expenses, and it will probably finance some income support payment out of its general corporate funds. Okay, this is called government insurance. Okay, now we are going to discuss about the private insurance. In private insurance, the focus is on individual equity. Each insured premium reflects the expected value of his or her losses. Private insurance is classified into life insurance and non-life insurance. Life insurance aims to providing financial security to the individuals and their dependents. The life insurance aims at providing financial security to the individuals and their dependents. The risk covered here is death in case of life insurance, sickness and disability in the case of health insurance. Okay. Annuity, on the other hand, provides financial assistance to old person with no earnings to meet their daily requirements. So the risk covered here is survival, only for survival. The following table sums up the salient features of the government and private insurance. Here we have to classify the insurance. Basically it is government and private. Under private, it may be in a three category. One is life, then non-life and health. So here we are going to differentiate three different types of insurance. One is government insurance, then life, non-life and health. Okay. Under government, social insurance through life insurance. In government sector, this is called social insurance, but this insurance is through life insurance. Example, Pradhan Mantri Jeevan Jyoti Bima Yojana. Pradhan Mantri Jeevan Jyoti Bima Yojana. The abbreviation is PMJJBY. Pradhan Mantri Jeevan Jyoti Bima Yojana. Okay. Under private, under life, this is annuity. Non-life is fire. Health is disability. A life is whole life. A non-life is marine. Health is long-term care. In life, it's a term insurance. Non-life motor insurance. Health is medical insurance. Okay. So these are all the salient features of the government as well as private insurance. Okay. The next one is in government insurance, social insurance through general insurance. Social insurance through general insurance. Example, workman compensation. Under life insurance, it's an endowment policy. Then non-life, it's miscellaneous. Non-life, it is miscellaneous. Okay. The third one is administer social security scheme. Administer social security schemes. Example, Provident Fund, ESI, etc. Administer social security scheme. Example, Provident Fund, ESI, etc. In life insurance, unit linked, and non-life insurance is a liability loss. Okay. Then one more is property loss. So these are all the salient features of the government as well as private insurance. Okay. The next type of insurance is individual insurance versus group insurance. Individual versus group insurance. If individuals are provided insurance coverage on their own lives, that is individual insurance. Group insurance is a means through which a group of persons who usually have a business or professional relationship to the contract owner are provided insurance coverage under a single contract. Generally, it is provided by employers for the benefits of their employees. But generally, this type of insurance is provided by employers for the benefits of the employees. Creditor and debtors groups like the loneliness of a housing finance company and miscellaneous groups like professional associations, religious groups, customers of large retail chain and savings account depositors, then poorer section of the society. Then landless agricultural workers also can avail the benefits of group insurance. The following table shows the difference between individual plans and group plans. Number one, under individual insurance plan, insurance on individual lives. Under group insurance plan, insurance on a group of lives. I mean group selection of risk. Okay. Under insurance, individual insurance, individual policies are issued. Under group insurance, a single policy is issued to the entire group called master policy. The third one is under individual insurance. This is voluntary and individual decision, no compulsion. So here individual insurance policy is based on the individual's interest, individual's own decision. No one can compel them. You have to take insurance policy. But in group insurance, contract between, compulsory for all new entrant into the group. So when a person enter into the organization, he has to take a group insurance. There is no second thought. But it is a compulsory one, it is a non-compulsory. Okay. Then fourth one, under individual insurance plan, contract between the individuals and the company. Here, one individual and company. I mean, insurer and insured, that's all. But in group insurance, contract between the group relative, group representative and the company. The leader of the group as well as the company. Then fifth one is it's a long-term contract. Life insurance contract is a long-term contract because it's for 10 years, 15 years, or 30 years, whatever it may be. But in group insurance plans, 1 year renewable contract. Every year we have to renew the group insurance plan. Okay. Then last one, the premium is constant throughout the term. Premium is constant in life insurance. Once you take a 5 lakh policy for 10 years, you have to pay quarterly premium of rupees 2000. It is always you have to pay 2000 up to the end of the 15th year. So here there is no chance for varying the premium in between the middle of the policy. But in group insurance, premium varies every year due to the change in the group. Okay. The seventh difference is underwriting standard or strict and individual selection. But here underwriting standards are very strict and individual selection. Here underwriting standards are very liberal. Only group selection, then rarely medical examination is required under group insurance. The next one is premium is higher as the administrative cost is high. So in individual insurance, here we have to pay some a little bit more premium than the premium paid under the group insurance scheme. Okay. The next one is individual has the choice of plan, term and sum assured. Here everything is selected by the individual. Choice, either it may be a money back or endowment, or term is short term or long term or fairly, quarterly or yearly, and sum assured maybe a lakh or for 10 lakh, 50 lakh or crore, etc. Here individual has no choice of terms of contract. Okay. So the next one is the participate in the profit of the company. So participate in the profit of the company. Here the company gives some bonus and dividend to the policy holders. Probably 95% of the profit will be distributed to the policyholder as dividend. But here do not directly participate in the profit. If the claims experience is favorable, experience rating adjustment is made in the subsequent years of premium. But in group insurance, there is a chance to reduce some premium in subsequent period. Okay. The terms of the contract depend on the individual characteristics in life insurance. But here terms of the contract depend on the characteristics of the group as a whole. Okay. So this is these are the difference between individual insurance and group insurance policy. So it is a very, very important question. Sometimes the question paper setter will ask this question like what are the differences between individual insurance and group insurance. Okay. Please all of you keep in your mind. The next one is, now we are going to discuss about what is life insurance. How is life insurance differ from general insurance or health insurance and annuities? Okay. Life insurance deals with the insurance of individuals, groups and pension plans. Since 1st September 1956, transacting life insurance business in India was the exclusive privilege of the nationalized insurance company, namely LIC. However, with the passing of the IRDA Act 1999, life insurance sector has been thrown open to private players. Okay. Number one, life versus general insurance. Here we have to classify and discuss the difference between life versus general insurance. Life insurance is on the person. Life insurance is on the person. It includes risk of untimely death, outliving, income, incapacity and injury or disease. General insurance or non-life insurance is on the property or liability, loss of person. So general insurance is not for human beings. It is not for the person. The life insurance is only for the person. So general insurance is for the property. The following risks are covered in life insurance. The following risks are covered in life insurance. Number one, for the risk of untimely death, unexpected death. So here life insurance or life assurance. The number two is for the risk outliving income. Take for example annuities, pension and endowments, etc. New pension schemes, NPS, come under the purview of Pension Fund Regulatory and Development Authority, PFRDA. For the risk of incapacity, incapacity means disability and long-term care insurance. It is not available in India. This type of insurance is not available in India. The last one is for the risk of injury or incurring disease, health insurance, accident insurance, and medical expenses insurance are applicable. It is available in India. All the three types of insurance are available in India. Because of its short-term nature, in India, health insurance was a part of general insurance. Because of short-term nature. Now, the health insurance is emerging. Now, there are exclusive health insurance companies offering health insurance products like example Star Health and Allied Insurance Company Limited, Reliance Health Insurance, etc. MetLife, SBI. There are a lot of health insurance companies are in live. Okay. The following risks are covered in general insurance. This insurance is to protect property, liability losses, and workmen compensation. The general insurance protect the following. One is property, then liability losses and workmen compensation. For the risk of the property losses, the property and casualty insurance, it covers the risk of damage to or destruction of homes, then automobiles, business and aircraft. Okay, so these are all the areas coverage. Damage to or destruction of homes, automobiles and business, aircraft, etc. For the risk of liability losses, liability insurance, here we have to take the liability insurance. In first one, they have to take a property and casualty insurance. But it covers the risk of payment due to professional negligence, product defects, then negligent automobile operations or harm to others or third party, third party property. Okay. The last one is miscellaneous insurance. So it covers the risk of travel insurance, bankers indemnity insurance, then crop insurance. So these are all the general classifications of general insurance. Okay. All these are covered in Model 2. The basic difference between life and general insurance are, here we have to know the difference between life and general insurance are, the risk namely death is certain in life insurance. You have to know what purpose in case we death, I death or they death. In case is it possible, who can take care of my family? So this is a question of life insurance. So the risk namely death is certain in life insurance. The only uncertainty is as to when it will take place. Where in general insurance the insured event may or may not take place. Either it may be or may not be, but here maybe, but when, where, no one is known this one. Okay. Second one is a life insurance contract is a long-term contract, while general insurance contract is a 1-year renewable contract. because you take life insurance for 15 years, 20 years or 25 years. But in life, general insurance, we have to renew every year. Then third one is, it is difficult to determine the economic or the financial value of life. No one has easily determined. Whereas the financial value of any asset to be insured under a general insurance policy can be determined. Okay. The next one is, the life insurance contract is not a contract of indemnity, but the general insurance contract is a contract of indemnity where the exact value of loss is reimbursed. Okay. The next difference is, the premium charged under life insurance policy is based on the mortality table, but the premium of general insurance policy is calculated on the basis of past loss experience, then probable risk factors and fixed tariff plans. Okay, this is a way of fixing the premium or charging the premium for these two insurance policies. Okay. And also you have to know the snapshot of the difference between these two type of insurance. First, you have to classify the two insurance. One is left hand side is life insurance, right hand side is general insurance. In duration, it is a long term insurance policy. Life in general policy is a short term policy. Risk of death is a certain in life insurance, but insured event may or may not be taken place in general insurance. Not a contract of indemnity is life insurance. Contract of indemnity is a general insurance. Difficulty to determine the financial value of the life in life insurance, but value of any asset to be insured can be determined easily in general insurance. Premium are based on a mortality table in life insurance. Premium are calculated on the basis of past loss experience, probable risk factor and fixed tariff for general insurance. Event is certain, but time is uncertain in life insurance. Here, event is uncertain in general insurance. Amount of claim is predetermined in life insurance. Amount of claim is not predetermined in general insurance. Okay. So the next classification is life versus health insurance. So here, what are the difference between, or what is the difference between life and health insurance? Life insurance is a valued policy, whereas health insurance is indemnified policy. The life insurance is a valued policy. Here we take the policy based on the value. Example, 15 lakh, 10 lakh, or 1 lakh, or 5 lakh. Somebody says, sir, I took 5 lakh policy last month. Example. Likewise, the life insurance is a valued based policy, whereas health insurance is indemnified policy. Most of the health insurance plan are short term and renewable in nature, whereas most of the life insurance plan are long term in nature. Okay. Based on the time factor, health insurance is classified under general insurance in India, whereas in other countries, health as a part of life is classified under the health insurance. The premium charged under a life insurance policy is based on mortality table, whereas the premium charged under the health insurance policy is based on the morbidity table. Okay. In other countries, products are available to cover additional expenses or losing income because of incapacity or loss of goods and loss of good health, which prevent the insured from being able to work and earn. It is called disability income insurance. Okay. If the incapacity prohibits the insured activities of daily living, it is called long-term care insurance. If the insured insures hospital, then physician or other health care expenses, it is called medical expenses insurance. Okay. In India, only medical expenses insurance is available. All these are covered in Model 2. Okay, in Model 2. The next one is life insurance versus annuities. What is the difference between life insurance versus annuities? Annuity is a periodical receipt in return for a lump sum payment or payment by installments made by the purchaser to the insurer. It's a lump sum receipt. It's a lump sum payment. The purchaser is called the annuitant. Annuitant. Premium is known as the purchase price. The accumulated amount is called corpus. These are pension plans suitable for these who do not have pension benefit after cessation of earning period through their organization, like professionals, doctor, engineers, etc. The following table shows that the difference between life insurance and annuities. The next topic we are going to discuss about is the economic basic of life insurance. The economic basis of life insurance. The economic values of life insurance. Any kind of loss due to death or disability of the earning member or the breadwinner leads to a decrease or termination of regular income besides any future income that he would have been able to earn had normally circumstances prevailed. The main function of life insurance is to provide protection to the family by ensuring continuity in income even after the death of the breadwinner. Okay. So these are all the evaluation models we are going to discuss. Over the years, insurance experts have tried to devise valuation models for how much insurance is required. For how much insurance is required. There are 5 models are available, valuation models are available. One is for the human life value model, then life cycle approach model, the multiple earnings model, the debt approach model, the needs approach model. So these are all the 5 models: human life value model, life cycle approach model, multiple earnings model, debt approach model, then needs approach model. So these are all the models. Now we are going to explain and discuss. We are going to discuss each and every model one by one in depth, okay, elaborately, okay. Number 1 is human life value model. So under this model, the economists have for a long acknowledged for the factor that people are an important part of a nation's wealth. But generally, because the population is the capital, it's a resource of the country. This is called human capital. Okay. Although they cannot be held similar to marketable assets like property, they are nevertheless assets and their economic value is determined on their knowledge and skills. They represent the human capital of the country. Already told you they are called human capital. It is the presence in abundance of the human capital which makes certain countries of the world more advanced than others. A noteworthy features of our present day economic system is the huge growth in human capital, largely due to education, which is an investment in human capital. Human capital represents the production potential of an individual. Human life value, HLV, mostly depends on human capital. The human life value mostly depends on human capital. This explains that interrelationship between human capital and life insurance, and it is an economic basis for life insurance. Human capital is production potential of an individual, whereas HLV, human life value, is a measurable or measure of the actual future earnings or value of service of an individual. Dr. Solomon S. Hubner of the Warden School, considered to be the father of life insurance education. He is a father of life insurance education. Propounded this concept at the University of Pennsylvania. His concept became the economic foundation of life insurance. Okay, this concept received wide acceptance, and it is quite different from the earlier held view that life insurance meant only payment of a certain amount on death. Death arbitrary, determined at the time of insurance without regard to the need of dependents. Okay, an illustration of human life value is given below. So we are all aware that death is inevitable for all human. So it is not the life which is insured in life insurance product. So it is the economic value of the life which is insured. People generally possess two type of properties. One is physical property, take for example acquired asset. Then the next one is earning capacity, then potential estate. So these are all the three important capacity of property. One is acquired estate, then potential estate. Acquired estate means physical property, potential estate is a earning capacity. Okay. In case of sudden death of the breadwinner, there is no effect on the physical estate because it is a fixed one. But the potential estate is lost permanently because the earning capacity of the family or of an individual is lost permanently. So what is actually insured through a life insurance product is an economic power in the form of individual earning capacity. Okay, with a life insurable product, the family can continue to derive the benefit of the earning capacity of the insured, even if he is not physically available. This is called insurance policy. Okay. The human life value is a measure of the actual future earnings or values of services of an individual. To be precise, human life value is the capitalized value of a person's net future earnings reduced by the cost of the man owns maintaining expenses of food, clothing, and shelter. This is the value of the bread earner as far as his dependent are concerned, and should ideally be the value of the insurance the bread earned should have. A given human life value is a function of its purpose and value to others. From the standpoint of one's dependents, an individual's human life value is the measure of the value of benefits that the dependent can expect from their breadwinner or supporter. Okay. From the viewpoint of an organization, the human life value of an employee is the value of his or her services to the firm. Thus, under this approach, there is not necessarily one single human life value. So each human life is unique. It is the value of a person's service that the human life value concept measures. This concept provides the economic rationale for the need of the life insurance, but not an economic explanation for its purchase. In relation to present value of the expected net earning of an individual, the same economic principles are applicable as in the appraisal value of the property. Hence, HLV provides a normative economic approach to life and health insurance planning. Okay. Now we are going to discuss about the 5 important aspects of human life value. The one is net capitalized value of future earnings. So what is the net capitalized value after the demise? Then creator of property value, the creator of property value. Then third one is the family is an economic unit organized around the human life value of its members. Fourth one, the family needs to be recognized and managed and its economic values finally liquidated in the same manner that other enterprises are organized, operated and liquidated. Then fifth one is economic link between the present generation and succeeding generation, example children education. Then sixth one is principles of business management in connection with the property values such as appraisal, conservation and indemnity and depreciation should be applied to life values. Okay. The next topic is life cycle approach model. It is one of the famous model to evaluate the human life value. The needs and requirements vary from stage to stage in a person's life. In the present economic environment, we have a number of economic instruments and catering to different types of needs and requirements of their investors. For example, an investment in housing will give the owners of shelter. There are certain financial investments which vary. Investor ought to make their relative priority changes with age. The following graph depicts the human life value at different stages. Okay, here you see four important stages. Four important stages. Yeah, from birth to death. From birth to death. A to F. A to F. Okay. So here A to E, A to C, A to F, A to B. So these are all the classifications. So you have to classify one by one. You see. Okay. You see. From birth to employment, A to C, there will be a dependency on parents. C to D is the active lifespan of individual because it's a earning period that start from employment and passes middle age, then senior stage and to the stage of retirement. So first from point C to E, it's a young age. It's a age for earning. It's a age for have a huge potential. So it is called young age. There is an inherent need for these people to secure or protect their earning capacity for the benefit of those who are dependent on them. A sudden mishap can shatter all the dreams of the young family, and therefore there is a definite need. Okay, to protect their earning capacity through a suitable measure or avenue, take care of minor health problems. Minor health problem. Provide accommodation to the family. Make provision for the requirements or need for the middle and old age. So these are the very important aspect of young age. Protect their earning capacity through a suitable measure or avenue. Take care of minor health problems. Provide accommodation to the family. Make provision for the requirements or need for their middle and old age. This is for young age, C to E. Then E to F, middle age, is the crucial period in the lifespan of person. Their need include one by one, a comfortable house, tax-oriented savings, provision for retired life, then provision for marriage and education need of the children. So this is for the second stage. E to F, it's a middle age. Okay. Then the third one is F to D, senior stage. The priority has to be given to health related problems. When we are crossing our 50 or 60, definitely we have to spend more money for our health aspect. So the priority has to be given to health related problems. Protecting their earning capacity does not rank high at this stage. Making superannuation scheme is also low at this stage of their life as its cost would be prohibitive. Then the next one is D to B. This is retirement stage. So under this stage, no more generating income on their own. Need to protect earning capacity is nil at this stage. No need to think about making provision for superannuation. So these are the four stages. We have to classify our life from birth to death. So based on this age, we have to make a protection about us in old age. For the protection of old age, we have to take insurance policy. In young age, we have a potential. We have to earn more income. Okay. All this need have been taken care of by them in their earlier stage of life. At this stage of life, what they need is a healthy life and accommodation of their own to stay under income to survive. Different types of plans or product are designated or designed by the insurance companies to fulfill the needs of all these stages. Okay. The next topic is demand for life insurance. Demand for life insurance as well as health insurance is influenced by human life value, then consumption and savings behavior of consumer over his lifetime, then human needs. So these are all the three influences determine the demand for life insurance. Okay. The next one is supply of life insurance. Supply of life insurance. The factors which influence the supply side of life insurance are risk bearing capacity of insurer, price of the product, technical expertise, capital, then last one is management capabilities. So these are all the factors influence the life side of life insurance policies. Okay, I'll stop my lecture now. So thank you very much for your patient listening. Thank you very much.